The stock market sounds complicated until you realize 90% of the jargon boils down to about 8 core ideas that keep getting recycled with different names. Bull market, bear market, PE ratio, short squeeze. Every single term exists to describe either what the market is doing, how much something costs, or how badly you can lose money if you mess it up. Today I'm breaking down every major stock market term you've ever heard, grouped by what they actually mean, with real numbers and real examples, so you never have to pretend you know what someone's talking about again. Starting with the stuff that sets the stage for everything else. Market structure. A bull market is a 20% or greater rise from a recent low, sustained over time. The S&P 500 climbed over 400% from March 2009 to February 2020, an 11-year run that convinced a generation stocks only go up. A bear market is a 20% or greater drop. During the 2007-2009 crisis, the S&P 500 fell 57%. Market cap is share price multiplied by shares outstanding. A stock priced at 1,000 with 1 million shares has a market cap of 1 billion. A stock priced at 50 with 1 billion shares has a market cap of 50 billion. The 50 stock is 50 times bigger. Price alone means nothing. An index is a curated basket tracking a slice of the market. The S&P 500 covers 80% of US equity market cap. The Nasdaq peaked at 5,000 in March 2000, crashed 78% to slint 100 by October 2002, then spent 15 years climbing back 7 times higher. Bull market, bear market, and index behavior all in one sequence. But if you think understanding the market's mood is enough, wait until you see how individual stock prices actually get set. How stocks are priced. There is no single true price for a stock. The last traded price is just where the most recent deal happened. Right now, there's a negotiation between buyers and sellers. The bid is the highest price any buyer will pay at this moment. The ask is the lowest any seller will accept. The spread is the gap between them, and it's an invisible transaction cost every trader pays. Here's where it gets real. A liquid large cap stock might have a spread of 0.02 on a $150 share. That's 0.013%. Buy 100 shares, cross the spread, lose $2, not great but survivable. Now do the same on an illiquid small cap. The bid is $4.50, the ask is $5. That's a 10% spread. Buy 1,000 shares at $5 and you pay $5,000. Sell immediately at the bid, you get $4,500 back. You just lost $500 before you did anything. The spread ate you alive. Volume measures shares changing hands per day. Heavily traded stocks can see 20 million shares on a normal day. But here's the kicker. High volume does not automatically equal good liquidity. During panic sell-offs, volume can spike while spreads widen simultaneously. You can trade, but not at fair prices. Plot twist, it used to be worse. US markets switched to decimals in 2001. Before that, the minimum increment was 0.125. After decimalization, spreads compressed to 0.01 minimums, a massive reduction in hidden trading costs. But if you think pricing mechanics are tricky, wait until you see how people decide what a stock is actually worth. Valuation metrics. Here's the thing. Bid and ask tell you what people are paying for a stock today, but valuation metrics ask whether they should be paying that. You can know the exact price and still have zero idea if you're getting fleeced. Let me introduce you to GreenGrid Energy, a fictional renewable power company. GreenGrid earned $600 million last year with 300 million shares outstanding, so its earnings per share, EPS, is 2. That's net income divided by shares. If the stock trades at 50, the price to earnings ratio is 50 divided by 2, which equals 25. You're paying 25 units of currency for every 1 unit of annual profit. Is a PE of 25 good or bad? Depends entirely on context. The historical long-run average PE for US markets sits in the mid-teens. Growth companies can trade at 30x or higher if earnings are expected to expand fast. Mature utilities might sit at 12x. GreenGrid at 25x suggests investors expect solid growth, justifying the premium. Book value per share is shareholders' equity divided by shares outstanding. GreenGrid has $10 billion in assets, $7 billion in liabilities, so $3 billion in equity. Divided by 300 million shares gives a book value of 10 per share. The stock trades at 50, so the price-to-book ratio is 5x. A price-to-book below 1 can be a bargain signal or a red flag that the assets are junk. Intrinsic value is where it gets interesting. You project future cash flows, discount them back, and compare the results to the current price. Build a model for GreenGrid, and you might land at an intrinsic value of 55 per share. The stock trades at 50, so you have a 10% margin of safety if your assumptions are right. And that's the catch. Models are only as good as your guesses. At least valuation metrics give you a framework to work with, unlike the next layer of complexity, which is figuring out how to actually place your orders without getting obliterated by the mechanics of the market itself. Types of orders. Most beginners think order types are just a minor checkbox when placing a trade, but they can completely change your outcome. Same stock, same day, 3 different order types, 3 completely different results. A market order executes immediately at whatever price is available. Fast, simple, no waiting. But in an illiquid stock or during a volatile swing, slippage can hammer you. Your last price of 50 becomes an execution at 52 because your buy swept through multiple price levels in a thin order book. A limit order gives you control. You set your maximum buy price or minimum sell price. Buy limit at 99 or at 50 means you will not pay more than 99.50. The trade-off is your order might never execute. If the stock never touches your limit, you sit there watching price move away from you. Then there's the stop loss, which most people think is a safety net. You own a stock at 100, set a stop at 90, sleep better, thinking you've capped your downside. But here's where it gets weird. A stop loss isn't a guaranteed exit price. It's a trigger. When the stock hits 90, it converts into a market order. If the stock gaps overnight from 100 to 85, your stop fires at the open and fills at 85. That safety net just dropped you further than you thought possible. Stop limit orders try to fix this by converting into a limit order instead. Sounds safer, but if price blows through your level, the order sits unfilled while the stock keeps collapsing. Which is, not ideal. At least with orders, you're in control of the mechanics. Unlike dividends, which operate on a schedule whether you like it or not, dividends and yield. Dividends feel like free money. Cash shows up in your account every quarter and you didn't have to do anything. Here's the thing though, it's not free money, and the mechanics of how dividends actually work will make you slightly angry once you understand them. Let's use Blue Wave Drinks as our example. Blue Wave trades at $60 a share and pays $3 per year in dividends. Divide that 3 by the 60 share price and you get a 5% dividend yield. Sounds great so far. Now Blue Wave's EPS is $5, they're paying out 3 of that 5 in dividends, giving them a payout ratio of 60%. The remaining 40% stays in the company for reinvestment. If that payout ratio ever creeps above 100%, meaning they're paying out more than they earn, that dividend is living on borrowed time. But here's where it gets interesting. Blue Wave announces a dividend with an ex-dividend date of May 8th. Buy shares on May 7th, you collect the payment. Buy on May 8th, the seller keeps it. And on the morning of May 8th, the stock opens at roughly 59.25 instead of 60 because that 0.75 quarterly payment just left the building. Your total wealth is essentially unchanged. You just moved money from one pocket to another, which is, not ideal. And that 12% yield you spotted on some random stock when the sector average is 3 to 4%, that's not a bargain. That's the market screaming that a dividend cut is coming because earnings are collapsing. Nobody's giving you 12% out of the goodness of their heart. I don't know what to tell you, but if dividends have all these catches, wait until you see how the people rating these companies operate. How companies are rated. Think of credit ratings like a report card, except instead of grades from your teacher, these come from agencies that decide how trustworthy a company is with borrowed money. The scale runs from AOA at the top, basically financial perfection, all the way down through AAA, BBB, and then, below BB+, you enter what's politely called high-yield territory. Everyone else calls it junk. Here's why this matters. The difference between investment grade and junk isn't just a label. It's money, real money. A company sitting at BBB borrows at 4.5% while the government borrows the same money at 3%. That 1.5 percentage point gap is called the credit spread. And it's literally the price tag the market puts on risk. Slip one notch from BBB to BB+, you cross into junk, and suddenly, entire investment funds are legally prohibited from holding your debt. Forced selling begins immediately. Now here's where it gets complicated. These agencies are paid by the companies they're rating, which is, not ideal. This exact conflict of interest blew up during 2008 when mortgage-backed securities carrying pristine OIROC AA ratings turned out to be worth approximately nothing. Billions in losses. OIROC I, cool. On the equity side, analyst ratings carry their own problems. A stock with 20 buy ratings, 8 holds, and 2 sells with a consensus price target and near rise implying 7% upside sounds scientific. But sell ratings are shockingly rare because analysts maintain relationships with the companies they cover. Nobody wants to torch a bridge. So here's your insider tip, a hold from an analyst who previously had a buy. That's the real warning signal. They're screaming sell without saying the word. But if you think ratings agencies being wrong is dangerous, wait until you see what happens when individual investors deliberately gamble with borrowed money. Risky moves. Short selling sounds simple until you do the math. You borrow shares, sell them immediately, and hope to buy them back later when the price drops. Keep the difference. Easy money, right? Here's the thing, when you buy a stock normally, the worst that can happen is it goes to zero. You lose what you put in. But when you short a stock, your losses have no ceiling, the stock can keep rising forever and you owe every single dollar of that climb. Short 100 shares at 50 bucks. Stock drops to 30, you pocket 2,000 profit. Beautiful. But if that stock rises to 80, you're buying back at 8,000. That's a 3,000 loss on a position you thought of as a 5,000 bet. And it can keep going. Now let's talk margin. Margin trading lets you borrow money from your broker to buy more stock than you can actually afford. Buy 20,000 worth of stock with 10,000 cash and 10,000 borrowed. A 20% gain means a 40% return on your actual money. Leverage doubled your win. But a 20% drop means a 40% loss on your equity. Perfectly symmetric, perfectly brutal, and when your equity falls below the maintenance threshold, your broker sends a margin call. Deposit more cash or we're liquidating. This always hits at the worst possible moment when prices are already in free fall, which is, not ideal. Now picture a short squeeze. A stock's at 20 bucks, hedge funds short it heavily, then retail buyers pile in, stock moves to 40, then 60. Short sellers are forced to buy back shares to cover, which adds buying pressure, which pushes the price higher, which triggers more margin calls. It's a feedback loop with no brake pedal. An investor who shorted 1,000 shares at 20 is now covering at 80. That's a 60,000 loss. Triple the original position value, gone. But if you think individual risky moves are dramatic, wait until you see what happens when the entire market decides to have an event. Market events. Let's bring this full circle with a story. Cloudscale Inc. is going public. Investment banks underwrite the deal, set an offering price of $30 per share, and the company raises $1.5 billion day one of trading. The stock surges to $45, a 50% pop. Champagne in the boardroom. Here's the thing though. That pop sounds amazing if you got shares at the offering price, but if you bought at $45 on day one because you saw the hype, you just paid a 50% premium for a company that may have been worth $30 12 hours ago. And historically, many IPO stocks underperform the broader market over the next 1 to 3 years. The first day pop gets all the headlines, the long-term underperformance doesn't. A few quarters later, they report earnings. EPS beats analyst consensus by 15%. Stock jumps 10% after hours. Because earnings aren't graded on an absolute scale, they're graded on a curve. Beat the number analysts expected, stock goes up. Miss by even a small amount, and it can crater. The expectation was already baked into the price. Cloudscale keeps climbing, hits $600. Management announces a 4-for-1 split. You're 100 shares. At $600, become 400 shares at $150. Total value, still $60,000. Splits do not create value. The company is worth exactly the same the second after as the second before. Cool. That's also a thing that happened. Then one morning, a geopolitical shock hits. The broader market drops 7% within minutes. Circuit breaker triggers. All trading halts for 15 minutes. If it hits 13%, another pause. 20%, done for the day. Go home. The idea is to prevent panic-driven freefall, though critics argue the pauses make volatility worse when trading resumes, which is, not ideal. IPO, earnings, split, circuit breaker. 4 events, one common thread. They're all moments where expectations slam into reality at full speed, and the gap between what people thought would happen and what actually happened determines whether you feel like a genius or get wiped out. That's what every single term in this video comes down to. The market is just people, with money, making bets about the future, using a shared language to describe what's happening, and now you speak it. If you enjoyed this video and want to see more, click the video on the screen now.